We are in Achievers MCQ series for BFM, and today's topic is very important from module B perspective. We will be looking at liquidity risk. So objective questions on liquidity risk. Now what is liquidity risk? Okay, I'll explain you everything. Okay. Before that, download Adda 24/7 app on your mobile. In this app you will be getting all the premium study material, current affairs, job alerts, daily quizzes, live classes, plus notes, question banks, everything whatever is required for JAIIB and CAIIB, you will get it. Okay. Also, subscribe to Officers Adda 24/7 YouTube channel. In this channel you will be getting the updates for various banking exams including JAIIB, CAIIB, and also you will be getting, very importantly, free YouTube series for all the subjects on JAIIB and CAIIB. So whatever is available free, go for it immediately, isn't it? This is a new English batch coming up for CAIIB. It will include all ABM, BFM, ABFM and BRBL, all the 4 subjects, and all the numericals, objective questions, everything, starting from January 20th. Okay. More on this later, but remember, don't forget this code Y432. It's a discount code to get maximum discounts. Okay. Let's start. Yesterday I had asked you one question. So what was that question? That question was, liquidity risk of banks arises from. So liquidity risk what do you mean by firstly liquidity risk? Let me explain you that first. Okay. Remember, liquidity risk basically means I don't have money to pay either my EMI or my principal, or both. Okay. So liquidity risk will be of 2 types, mainly remember this. Okay. Liquidity risk. Okay. It will be of 2 types. One is I don't have money, no money to pay this principal, and second is interest, and third is combined, both. Okay. So it can be both also. So if I don't have money to pay principal, mainly you will face this problem in major companies, some big companies who are having a cash crunch. Okay. So in that case, what happens when you have a liquidity risk? You have to borrow the money from various other financial institutions. Okay. So coming back, liquidity risk of bank arises from funding of long-term assets by short-term liabilities. Funding of short-term assets by long-term liabilities. Funding of long-term liabilities by short-term assets. Which of them is true? A, B, C or D? Which one? Is it A or B or C? What do you think should be true? Okay, let me explain you over here. See this. Always remember one simple logic. The logic is there are 2 things in any banking, right? One is what? Liabilities. Liabilities means deposits. Okay, liabilities, and second is assets, right? These are the only 2 things. What does the bank do? Bank gets money from the liabilities. Here, depositors invest the money. See this. This is a depositor, right? Depositor. So this person invests the money. Okay, and what does bank do? This is the bank, right? This bank gives the money to the loan person, right? So this is a loan. So logic is this. So what happens? Funding of long-term assets. Suppose imagine I take a deposit of 1 year. 1 year. Okay. And I give a loan for 3 years. 3 years. Means 1 lakh loan. I take a deposit of 1 lakh. Okay. And I give a loan of 1 lakh. Again, same 1 lakh I am giving it as a loan for 3 years over here. So what will happen? After 1 year, this person who is the depositor will come to me. He will be requiring the money from me, because he has deposited. He will be asking for the money. So within 1 year, this person will come for the money. But this guy, to whom I have given the loan in 3 years, for 3 years, this guy, even if I divide it equally in 3 years, in first year, how much will he be given? Only 1/3 amount, right? So what about the remaining 2/3? I'll be having a cash crunch, right? So that is known as basically liquidity risk. So funding a long-term asset from short-term liabilities. This is option number A. Okay, let me write it over here. This is option number A. Second option is what? B. Funding a short-term asset from long-term liabilities. Means if I take a deposit of 3 years, imagine this. Okay, 3 years deposit, 1 lakh. Okay, and I give a loan of 1 lakh. 1 lakh for 1 year. 1 year. Okay. So will I face any problem? Because this person will come to me for money after 3 years. This person will repay me in 1 year. So will I be facing the problem in B? No, definitely not, right? So B can't be the answer. Funding the long-term liabilities from short-term assets. How can I fund a liability from the asset? It can't be done. Always assets are to be funded from the liabilities. Liabilities can't be funded from the assets. So this is ab initio wrong. So C is out. B is out. So what is the answer now? Only A, right? So liquidity risk in the bank will arise if I face this problem. Okay, got it, everyone? Chalo, move on. Next one. There's a light issue today, but that also okay. We can move on. Okay, funding risk, funding liquidity risk is defined as, means what do you mean by funding liquidity risk? Funding and liquidity means what? See here, funding liquidity means, I told you earlier, mainly cash crunch. Okay, cash crunch. This is known as okay, cash crunch. Sorry, crush. I wrote it crunch. Okay, cash crunch. Okay, so what is funding liquidity risk? Okay, let's see. Excess of liabilities over assets means if I have more liabilities than my assets. Number one. Excess of long-term liabilities over long-term assets means if I am having more long-term liabilities over my long-term assets. Third, excess of short-term liabilities over short-term assets. Number three, inability to obtain funds to meet the cash flow obligations. Which one do you think should be the correct answer in this? Yeah, excess of liabilities over assets. Okay, so if I have more liabilities to give than my assets, right, I'll be facing this liquidity risk. So let me write this answer as one more option. Let me give you all of the above. All of above. Okay, let me give this option now. Let me see how many of you think. What should be the answer? A, B, C, D or E? All of these. Yeah. If I am having, let's say, excess of liabilities over assets, means if I am having more liabilities. Liabilities means what? Here, logic is simple. Liabilities means liabilities and assets, right? Assets. Liabilities means here I have to give interest, right? Give interest. And here I get interest. Simple. I'm a bank, right? Get interest. Okay. So if I am giving more interest, then I am in a financial problem, or if I am getting more interest, then I am in a financial problem. So A can be true. Excess of liabilities over assets, right? I am having more liabilities. I have to give more interest. So I'll be definitely facing the liquidity risk. Excess of long-term liabilities over long-term assets means this is also long, this is also long. So that can also be the answer, correct? Excess of short-term liabilities over short-term assets. Again, this can be the answer, because short-term liabilities I am having more and I am having short-term assets less, means logic remains the same. Liabilities more than the assets. So C can also be the answer. Inability to obtain funds to meet the cash flow obligations means if I can't get funds to meet my cash flow obligation, when will this happen? This will happen if I am giving 100 rupees over here and I am getting only 60 rupees over here or 70 rupees over here. Then I'll definitely face the cash crunch, isn't it? Inability to obtain funds to meet the cash flow obligations. I can't give the funds to these guys, right? So there I'll be facing the problem, isn't it? Got it? Everyone clear? So what is the answer now? Correct answer is E. Okay, E. It's not A, not B, not C, not D, only E is the, because all of them are correct. Got it? Move on. Okay. Firstly, everyone like this video. Type yes in the comment section up till if you have understood up till now. Everyone, type yes in the comment section. Everyone, I'll just wait over here. Okay. Like the video. Click on that bell icon on the channel. Okay. Liquidity risk in bank manifests in different dimensions. Manifest means comes. It shows its face. Okay. Comes, I'll write it. Comes. It's very simple, isn't it? Let's use simple words. But what happens in banks, in your JAIIB, CAIIB exam, they give you some difficult word. That's why I've used it over here. Okay. So liquidity risk in banks manifests in different conditions. So what can be the conditions? Which are these? Funding risk arises from the need to replace net outflows, withdrawals, not non-renewal of deposits. So, can this happen? Means funding risk arises from the need to replace net outflows. Means I am having more net outflows. Net outflows means what? Income minus outgoing. Here again same. Here every time banking is same only. Liabilities and assets. More going over here and less. These signs are confusing. More over here, okay, and less over here. Less coming, incoming. Okay, so definitely you'll be having net outflows, right? So does this liquidity risk come in condition A? Let's see. You have to answer it. Time risk from the need to compensate for non-receipt of funds. Can this happen? Means non-receipt of funds in assets. Let's say I'm having the assets over here. Let's say the loan becomes NPA. Okay. Now this guy is not paying me at all, but this depositor I'll have to pay it at any cost, right? So time risk arising from the need to compensate for non-receipt of funds, right? Call risk arising due to crystallization of contingent liabilities. Means what? What do you mean by this? Crystallization of contingent liabilities means guarantees, okay? Guarantees, LCs, all these are contingent liabilities, okay? Now, can I say this this call risk arising due to crystallization? Yes. What do you mean by crystallization? Crystallization means if I am, let's say, the bank B over here, okay, I am the bank, and this is my customer who contractor. He is a contractor, okay, he or she. I don't say he only. She can also be the contractor. Bank, and then the customer is a contractor. He takes a contract of, let's say, any municipality, okay, municipal. I'll just write it, okay. He takes a contract of this municipality, but this municipality requires a guarantee. So I give a guarantee as a bank on behalf of my customer to this municipality. Now what does this guy do? This guy doesn't perform. So this municipality will do what? It will ask for this. I have given a guarantee. This municipality will come to me and ask for money. Once it asks for money, I'll have to give it. So this is known as crystallization. Okay. So remember. Okay. So what is the answer? Funding, and last one is both A and B. And call risk arising due to crystallization of this contingent liability. In fact, both A, B and C I should write it. Okay. A, B and C all. So funding risk arising from the need to replace net outflows from non-renewal of deposits. Means I am not getting the deposits renewed, okay, or this there are net outflows from my side, so that can also be one reason. Time risk, that is also one reason. C, call risk, crystallization, that is also one reason. So the correct answer becomes correct D over here, okay. So not both actually, A, B and C all of them can, this liquidity risk can come in any of these three forms. Got it? Where an asset is maturing in 2 years, the liability risk will be. Means, what do you get means by this? When an asset is maturing in 2 years, a liability risk will be basis risk, yield curve risk, gap risk, embedded option risk. So what can be this risk, man? What is this? I didn't understand this at all. So what can be this risk? Yeah. Where an asset is maturing in 2 years means now my loan. Asset means what? Loan. My loan is maturing in 2 years. So what can be the liability risk to me? The liability risk to me can be basis risk, yield curve risk, gap risk and embedded option risk. What can be the answer over here? Which is the main risk to any liabilities? Any liability, the main risk is embedded option risk. Correct? This is the main risk to any liability. Why? Means what? This asset guy, he will be paying me in 2 years, but this liability person, see here, I'll always have to match the liabilities with assets. Okay, if I give 100 rupees as loans, I will have to have minimum 100 rupees, at least 100. Actually, the rule is very different. Okay, the rule is generally 60 to 100. Okay, means if I'm having 100 rupees as deposits, then I can give 60 rupees as loans. So what happens is, if this asset is going to mature, imagine in next 2 years, So I'll have to keep a track on this liability. If I don't have this liability, then from where will I give this loan later? So this is known as embedded option risk. Embedded option risk means this liability person can come to me anytime, and ask me, sir, give me my money back. This is your FD, take this money and take this FD and give me my money back. So main risk which I'll always be facing while matching the asset and liabilities is embedded option risk. Okay. Same risk can continue for the assets also. How can it be continuous here? This asset is maturing in 2 years. So what happens? This person comes to me tomorrow, okay, and says, sir, this is your money. Full money repaid. Full money repaid. Now if somebody repays me fully, where will I get the interest in future? So this is also an embedded option risk, okay. So when an asset is maturing in future, the liability risk will be embedded option risk. Got it? Clear? Now what about the basis risk? Basis risk means what? It is the difference in change of the interest for assets and liabilities. But what happens generally when the asset is maturing, this loan, this rate of interest is generally fixed by me over here, and liability also deposit. If generally we are talking of FD, so this rate will also be fixed by me. Okay, so once it is fixed, then there's no major problem as such. Yield curve risk. Okay, yield curve means what? The rate of returns related to bonds. Yield curve is always related to bonds. Okay, bonds. So this is not related to directly to the liability or the means saving and current deposits. Okay, yeah. Gap risk is mainly related to NIM, net interest margin. Okay. So main option whenever any asset is maturing in future, the main problem to the bank will be the embedded option risk. Okay. The risk of adverse variance of mark to market value of change in price in the interest rate instruments equities is called as, what is this? The risk of adverse variance. Adverse variance means the price going adversely. Okay. Of mark to market. Mark to market means what? This is always available in trading portfolios. Here bank always has two portfolios. Okay, bank always has two portfolios. One is banking book, right, and second is trading book. Banking book is always for the statutory reserves, means CRR, SLR, everything. Okay, here the bonds which are purchased are never sold, and here the bonds which are purchased are sold for profits. So the risk of adverse variance of mark to market value of change in market prices, here market prices, okay, of interest rate instruments, equities, instruments and equities, it's comma, okay, is called as price risk, market risk, translation risk, both A and B. What is all this, man? Just tell me. Okay, let me get the answer from you. Price risk means what? I'll explain it in the meantime. Okay, price risk means what? If I purchased a bond, okay, okay, I purchased it for, let's say, 120 rupees and the face value is 100. Now if the bond price goes to rupees 110, then 120 I have bought it, it's at 110, so I'm at a loss. When will this happen? This will happen if, see, the price moves down, if the interest rate moves up. If the interest rate in the market goes up, my price of the bond will go down. Okay. So now, if this is a case where my price is going down, so will it be a mark to market? Yes, it can be. What about market risk? Market risk means what? Anything. This 120 goes to 110 due to the external situations which are not in my hands. Means, let's say for example, Russia attacking Ukraine. Okay. It's not in my hands. Does your bank, can your bank do anything? Can RBI do anything? Nothing. So it's outside the purview of your system. So that is called as market risk. But because of that also, the prices of the bonds vary. Prices of the equities vary, right? So price risk, market risk, translation means what? Translation is totally different here. Translation risk I'll explain you. Suppose there is SBI, okay? SBI, let me come for example. I'm giving an example of SBI. Don't take it literally SBI, okay? And there is SBI USA, okay? SBI is having the branch in USA also. So this USA branch will be operating in dollars. This Indian branch will be operating in rupees, right? But the balance sheet on 31st March, okay? Because after all, this SBI USA is a branch of SBI only, isn't it? Main parent company is this only. So on 31st March, SBI will have to give the report to RBI. Let's see, this is my balance sheet, this is my blah blah blah, everything, okay. So when it gives the report to RBI, the balance sheets and all the documents, at that time it will have to report the figures of this SBI USA also. So how will it report? This is in rupees and this is in dollars. So what will it do? It will convert it to notional rupees. Here, this is known as notional. Important word over here. Notional means on 31st March, whatever is my balance of SBI USA, I'll just convert it to rupees and bring it to over here. But does it mean I'm closing SBI USA? No. SBI USA is running on 1st April also, isn't it? Next day also. I'm just bringing this as a notional profit or loss, whatever it is. So that is known as the translation risk. Translation means converting this dollar currency to rupee currency virtually, notionally. I am not closing down that business. Remember, you will always get confused between translation risk and crystallization of forex. In crystallization of forex, I am closing that loan of dollar and bringing it to rupees. But in translation risk, I am not closing that forex entity. Okay, got it? So the answer is what? Yes, it is D, both A and B. Okay, both A and B. Now one for your homework. In a financial market, bond prices and yields are, just now I told you something. In financial market, the bond prices and yields are inversely related, directly related, inversely or directly related, depending on the type of the bond, and none of these. So this is what you have to think now. Okay. So before going, let me tell you again, this is the new batch coming up on January 20th. In this batch, we are covering all the numericals, objective questions, theories, case studies, everything. And remember, there are huge discounts going on. Okay, this is very important word, discounts here. We are Indians, we should always purchase anything at discount, isn't it? It's a habit, isn't it? So we should do the same thing, isn't it? So let me show you how to get the discounts. Let's go to Adda 24/7 live. Okay, once you go to Adda 24/7, says you click on JAIIB and CAIIB. You see this JAIIB, CAIIB, JAIIB 23. So Mahapack or CAIIB 23. You are in CAIIB. So click on CAIIB 23. Here you will see the batches. See this. This batch starting from January 20th. Click on that batch. In the batch, when you click on this, you will be getting the details of the batch. Go on reading. See this. Go on reading completely whatever is given over here. Okay. See this. You will see the batch timings, the dates, batch timings, everything you will be seeing it over here. Okay. Also the study plan is given over here. Also importantly, main points I'll just cover, that is recorded 24/7 videos available anytime, so that if you miss out any class due to any banking pressure, you can definitely revisit the class. Okay. Also it's a two-way interactive class, so you can ask the question then and there itself. Okay, and get it clarified. Let me come to the discount part. See this, because money is very important in life. Okay, so 23,999, this is the fees. What you do is click on view offers. Once you click on view offers, put the code Y432, click on apply. Say this, my god, 23,999, this discount is 4, means you are getting the discounted price of 4,799, 80% off you are getting. Such a huge discount, you never get it always. Okay, so go for this batch. Instead I would suggest one more thing, one more advantage I'll give you. Okay, that advantage is go for the Mahapack. What is this Mahapack? Let me show you Mahapack. Okay, see this, click on this JAIIB, CAIIB again, come to the front page. If you are having the app, I would suggest go on the app. Okay, in the app you can get 1% extra. So click on JAIIB and CAIIB, go click on this Mahapack now. Once you click on the Mahapack, you will see the Mahapacks over here. Click on CAIIB ka Mahapack. See this. Once you click on this CAIIB ka Mahapack, look at whatever is given over here. Now all the details are same, means you will be getting roughly here. Main point over here is, what is this Mahapack? You get multiple batches. How many multiple? You will be getting 15 plus batches for ABM, BFM, ABFM and BRBL. Means such a huge huge number of batches you are getting. Okay. Recorded videos are available as obvious, right? 15 plus full length mock tests are available. Then 50 plus topic wise questions are available. You can get everything. Okay. Okay. Now coming back to the price part, see this. The costing over here is 35,996. Click on discounts now. Click on view offers. Okay. Put the code Y432. Click on apply. Look at this. Now the 35,996 reduces to 7,199. Such a huge discount you are getting again, and 80% off, plus the validity offer which you are getting is 6 plus 6 months, 12 months validity you are getting. So you should go for it immediately, okay? Now I'll come to the portion. Why am I stressing on these batches? Why am I stressing on the classes? Because the new portion which has come for CAIIB is different. Different means it has changed. See this: ABM, BFM, ABFM, Advanced Business and Financial Management, and BRBL, Banking Regulations and Business Laws. So these are the two new subjects which have been added. Also remember the electives. Electives have been removed now. Electives means removed means the retail elective which was there, it is removed now. So now you don't have retail elective. You have all that HR, IT, then risk, then central banking, but you don't have retail. So that's why the negative marking is also removed now. That's a good advantage to you guys, okay? Because otherwise you would have faced the huge problem over there. So negative, good, it's good for you, right? Good for you. So I would suggest go for these classes ASAP, okay? You will be needing a mentor, okay, for clearing these exams. So I'll stop over here. Tomorrow I'll be back with the new session. Bye.